This is section 3.2, non-retention workout options. So the first non-workout option is a short sale, and that's a circumstance where the holder, the owner of the mortgage, agrees to accept less than the amount due on the mortgage. It involves a market sale of the property, usually through a realtor who specializes in short sales or distressed properties. In those circumstances, the holder may agree to waive the deficiency, and that's a key point. They don't have to waive the deficiency judgment in most circumstances, so be aware of that. It would typically be inaccurate to tell a borrower that always in a short sale the holder is going to agree to waive a deficiency judgment. So just be reserved about the language that you use when you're referring to the effect of a short sale. Usually there's a set time within which the short sale has to be completed, and just like everything else, this is going to be very investor specific in terms of what their requirements are. Some of them require that the property be listed on the open market at or above a market rate for a period of time before they'll accept a short sale offer. And as far as credit reporting, it's going to be noted as a short sale on the borrower's credit report when it's completed. So there can also be a short payoff on a refinance. Servicers agree more readily to a short sale, and a short sale must net a certain amount established by investor or insurer guidelines. And the reason that they typically will readily accept a short sale is because they get an infusion of cash, right? They're not going to have to take possession of the property. They're not going to have to pay someone to list it, pay someone to drive by and take care of it. So they get that cash, they can be done with it, cut their losses, and re-lend that money to someone else. Second option here, a deed in lieu of foreclosure, also known as cash for keys in some circumstances if there is a monetary incentive for doing it. Typically, in some circumstances, the borrower has to attempt to sell the property at a full price or attempt a short sale first. So just like you have your waterfall of options with retention, occasionally the investor will require the borrower to try a market sale, then try a short sale, then they'll be willing to do a deed in lieu. So that's not uncommon for that to be the case. It's important to note that more likely than not, a deed in lieu of foreclosure is not going to be accepted if there's junior liens on the property or if there's tenants. The only caveat I'll say to that is that, aside from tenants, if there's a junior lien on the property, some investors do actually have programs where if it's a small enough lien, they may actually forward the cash to pay it off if it's a really small amount. So just keep that in mind and make sure you ask the servicer very specifically about that. If you've got a borrower that really is interested in pursuing a deed in lieu, but you know there's a small lien on the property, whether it's a tax lien or a mechanic's lien or whatever it is, just have good communication with the servicer and figure out how this particular investor deals with that kind of situation. The lender should agree to forgive a deficiency or provide extra time in the property for the borrower. Usually the way I've seen it structured is if they do a cash for keys, you get more cash for getting it completed sooner. So they may say, hey, if you can be out by the end of next month, we'll give you $2,000. If you're out the month after that, it goes down to $1,000. And that's just a way of them to curb their losses, get the property back more quickly so that they can hopefully sell it more quickly. A deed in lieu is worth doing when the homeowner does not want the house and the house has, I wouldn't say no value, but let's say they don't have a lot of equity in the value. There's no point in listing the property. The borrower knows that it's probably worth $60,000 and that they owe $80,000 or $100,000. They're more likely than not they're just going to want to get out from under it. Or if it's a situation where a borrower just realizes, hey, I can't keep up this property anymore, it's too big, or the utility bills are too high, or there's too many problems, then a deed in lieu can be a good option. And of course you can negotiate to get cash, but most likely there's going to be investor-specific guidelines about what that cash incentive looks like. Assumption. Some mortgages can be assumed by a third party, and that basically means that the person to whom it's transferred can pick up payments on the mortgage, and then the new borrower is then liable for a default. This is common in situations where there's a transfer from parent to child, death of a borrower, assumption by heirs. The important thing to note about this is that it doesn't necessarily make it impossible for that person to pursue loss mitigation so long as they've already pursued legal title. If they don't have legal title to the property, they're going to need to see an attorney to get that done. And then as far as assumption goes, if the property or if the loan is in a default status, many investors do allow the ability for a borrower to pursue a simultaneous assumption and loan modification. So they're going to submit that normal borrower assistance package, and then it's possible that they can also at the same time, let's say they get a positive answer back on the request for assistance, and then they can at the same time assume the mortgage. And the reason behind that is, why would someone want to assume a mortgage that's in default? So you want to the borrower wants to make sure that if they're going to take on payments, that the loan is going to be in a good status and be reported as being paid on time for credit reporting purposes, and so that they can kind of get a clean start. So you're going to review activity 3.1. You're going to evaluate at least one of the three scenarios listed and provide an analysis of the feasibility of each of those retention or non-retention options listed. Just look for further instructions in Blackboard for this activity. That is the end of section 3.2, non-retention workout options.